Get ready before life happens. The podcast helping you navigate life's what ifs.
Welcome to the Get Ready Money podcast, changing the way we think about money. I'm your host, Tony Stewart. Today, I'm joined by Jose Mayora, author of Wall Street's Blind Spots, and we're going to talk about his book and exposing the blind spots in the investment world. Jose, welcome to the podcast. Thanks for joining us today.
Thank you very much, Tony. I'm happy to be here. Thank you for having me.
Yeah, no, it's a pleasure. So, let's start off with a little bit about, what is your origin story and how did it lead you to write Wall Street's Blind Spots?
No, absolutely. And maybe I'll start from where I am today and kind of work my way backwards. So right now I'm the senior portfolio manager and co-founder of the first public equities hedge fund in Central America and possibly in Latin America, although that's a bigger universe, so I can't be so sure. And we're based here in Guatemala, and we operate from here. And the way I kind of got to this place and why I decided to write the book Wall Street's Blind Spots is because I came from a finance background ever since I got out of high school. I studied finance and economics at the University of Virginia. Then I worked in investment banking for almost 5 years. I took the CFA exams, the three of them, and passed them while I was in investment banking. Then I went to do a master's in economics. And to make the long story short, while I was going through my kind of initial professional career and kind of my educational setup, I started to question a lot of the premises that kind of people take for granted within finance and within investing. And very early on, I remember I kind of just I don't want to say fell in love, but I really clicked with the school of thought of value investing, which ironically isn't really taught in school and isn't really taught in the CFA. So I was kind of doing a parallel process where, on the one hand, I was taking like the more traditional financial education, but on the other hand, I was just devouring books that were more related to value investing and the implications about value investing. So I kind of was able to get to two sides. And I always wanted to kind of at least work, if not operate my own fund focused within the ideas of value investing, which of course we can discuss in a couple of minutes if you want. But I wasn't sure whether Guatemala was the place I could do it. And I always knew I wanted to come back to Guatemala after my education and early career, just kind of, for personal reasons, family and such. But the reality is that Guatemala and Central America, the culture for investing in public markets or in stocks, it's still very, very low. It's very underpenetrated. And so I wasn't sure whether I was going to be able to make it or not. But to make the story short, my partner, he has had a family office that he's run for over 2 decades. And I came to talk to him because I know him for personal reasons. And I came to talk to him just to kind of get a sense of whether he thought it would be possible or even worthwhile to explore the possibility about opening a fund. And so we started talking about some ideas and especially value investing, which coincidentally resonated with him a lot as well. And so after talking for a while, we just kind of stood there and he said, you know what, why don't you come and join me and we partnered together to do the fund. We knew we were being pioneers on it, but because of that, we knew it was going to take a lot of an educational effort towards existing and potential investors. In fact, when we pitch or present the fund to potential investors, I always say it's kind of like a mini course on value investing, and we want to make sure the investor knows what he's getting into, and it's very important because public markets, you need to have emotional intelligence, which we can also talk about the importance about that. And the only way we as managers can have emotional intelligence and work through the markets and the volatility is if we really educate them and they really know what they're getting into. So the pitch is really more of an educational effort. But even then, it's very difficult to transmit the importance of the ideas and the focus on long terms and things of that nature. And so, maybe about 3 years ago, I started kind of thinking about what efforts I could do, whether it was a course or whether it was a book, to kind of get the ideas out there. But I was kind of putting it off. And after a while, I did realize that investors do value our educational efforts a lot. And I also started to realize that even though we fall under the value investing umbrella, the way we think is actually very unique, even within this niche. And the way we value businesses and the framework we use and the approach we use is actually very unique and kind of has what I call the blind spots, which is why the book is called Wall Street's Blind Spots. It's because essentially we emphasize and we focus on things most investors, even value investors, we think miss, and we think that to their peril, right? So when I started to realize that more and more over time, I kind of said, okay, let's just jump on the boat and let's try to write a book. And it's been, again, that parallel effort about education for our investors, both existing and potential investors. So sorry if I extended myself a little bit, but that's kind of like the story.
No, that's great, and that's a great journey. I think that many of us go through that write a book as professionals. Is that it's a reflection of our learnings as we go. As my first book was that way. It was something where I actually compiled a lot of articles that I'd written, added some other context to it, but it was essentially the learnings that I had to that date that I thought would be helpful for people. You covered a lot of things that I think would be great topics for us to talk about. The first thing is you mentioned a hedge fund. And for many of us, we hear the term hedge fund and we think of billionaires and everybody who's running a hedge fund is a billionaire. Could you just go through real quickly, what is a hedge fund and what's the reality of running a hedge fund?
No, absolutely. And you're right. I mean, the hedge fund world is so vast and wide that you can really find everything in terms both of the type of investing that a hedge fund does and in terms of the structure and where they're located and things of that nature. But essentially, a hedge fund at the end of the day is a fund or a pool of capital that you get from various investors that you can invest with kind of a wide flexibility. So if you compare it to, for example, more like a mutual fund, it's also kind of the same concept. You're pulling money from investors. But maybe what distinguishes the mutual fund with the hedge fund the most is that mutual fund is highly regulated and they're very limited in terms of kind of how they can invest, what they can invest, the diversification that they can have, and their mandate towards the investor. Versus the hedge fund is more of a situation where you as manager, as long as you're transparent with your investors of what your approach is, you have absolute flexibility with how you invest their money. And in our case, that was pretty important because part of what distinguishes value investing in general, and again, this is just a very tiny thing because there's a lot of things that go to it, but part of the things that distinguish value investors and definitely us is that we manage a very concentrated portfolio. So our fund right now, for example, only has 15 stocks. And I don't think there's a mutual fund in the world who would have that level of concentration. And there's good reasons for that. And a hedge fund is not necessarily for everybody. And our fund, again, is not necessarily for everybody. But we did need that flexibility to be able to have that level of concentration and flexibility to manage the portfolio where we think offers the best risk reward for ourselves, because obviously we're investors as well, and for our kind of third party investors.
Yeah, well, I think you said something very interesting at the end, and I think that this is something for investors that are important is to find a hedge fund manager who's actually putting their own money in a hedge fund. Is there are a lot of hedge funds where the manager is not putting in their own funds, and I think that's not good.
No,
Is you know
a-
is it
absolutely. There has to be skin in the game, and especially in hedge funds, because again, the strategies of hedge funds can be so unique that if you're asking other people to bet on you, you have to be able to bet on yourself. And in fact, I always tell people, I have a commitment towards my investors. I mean, it's not something that's written or anything, but it is a verbal commitment. And I say this all the time to them, and I say it publicly, like I'm doing right now, is uh, pretty much all my long-term savings are either on the fund or on stocks that are part of the fund. And that's a commitment. Like I always say, I will never own anything else other than like, cash or things that might need my short-term liquidity needs, right? For my day-to-day. But in terms of long-term savings, everything's either on the fund or the stocks that are within the fund. And maybe you could ask, well, why not everything in the fund? And part of the reason of that, and I don't know if you want to get into it, but it's just that I'm okay having even more concentration than we have in the fund. And with investors, you also have to be cautious, and sometimes you need to balance what the best strategy is, but also the journey that you're going to give your investors. And so, I'm willing to be a little bit more concentrated, and so sometimes I take personal money and invest in the stocks that are within the fund, but with a little bit more concentration. But again, that skin in the game is very, very important, and it's something that we take very seriously.
well, that's interesting because I think that's some good takeaways for people. I mean, in the US, I think do you have to be an accredited investor to invest in a hedge fund in the US? Do you know?
Yes, you do. I don't know the particulars to be honest, but even within our structure, because even though we operate from Guatemala, we our fund is structured in BVI, the British Virgin Islands, and a lot of U.S. funds are also structured in British Virgin Islands, and there's regulatory reasons for that, and it's not the only place. But so I do know a little bit about it. Not an expert in any way, but you definitely can't offer hedge funds to anybody. And that's why mutual funds are much more restrictive in how they can invest versus hedge funds. And, accredited investors, I think in the US, you have to have, I think it's $1 million net worth and $250,000 salary or something like that. Not salary, but income annually, something like that. So there are parameters. And so you can't offer a hedge fund to anybody in the street.
Yeah, and so it's something for people to keep in mind. But as your assets grow, a hedge fund can be a good option. This is not an advertisement or an endorsement of
Absolutely.
hedge funds by any means, but I think what you're saying that's super important for people to take away is that the regulatory impact is different for a mutual fund and a hedge fund. So when you make that move, if you make that move to a hedge fund, is to understand that and to really understand what you're getting into and the philosophy of the hedge fund and everything else. So, let's talk about value investing, is because people talk about it. I personally love the concept of value investing, going back to Benjamin Graham. There's some guy, Warren Buffett, who's done okay with value investing, John Bogle, the founder of Vanguard. These guys did okay with value investing. So what is value investing, and how is it helpful for people?
No, absolutely. Value investing in theory is very simple. And putting it to practice, it's more difficult for various reasons, but in theory, it's very simple. It's just the idea that you're trying to invest in assets, typically stocks, but it could apply to any asset, in a way that you're trying to buy the asset at a price lower than what you think it's worth. So you're looking at a stock, maybe you're looking at Apple or whatever it is, and you see, okay, Apple today's valuation is somewhere around $3.2 trillion or something like that. I don't know. And you'd say, okay, maybe that's around fair value. I'm not saying this is the case, but again, just using it as an example. And you don't want to buy it at what you think fair value is. Instead, you're going to wait, if it ever happens, for Apple to go down to 1.5 trillion, for example, looking for a wide margin of safety and then doing your purchase at that point. And the idea when you do that, and this is why I love what I love about it is that it helps you kind of break that risk reward paradigm that we're all subject to in finance. So you know how, if you want more returns, you typically have to put yourself at a higher risk, and that risk reward relationship that is linear. That tends to be the case in most cases. But when you do value investing, again, at least in theory, and if you do it well, because you're buying businesses or stocks at a discount, the probability of loss becomes very, very low. And this is in the long term. The probability of, downside in 1, 2, or 3 year periods can be very high. But over the long term, the probability of loss is very, very low. And yet the probability of a great return, it can be really, really high. So it's kind of that the best of both worlds, low probability of risk, high probability of return. Obviously, I emphasize the word probability because nothing guarantees it. And again, it's not as easy when you're putting it to practice. But if you're able to do it well, it really can help you kind of propel your wealth over time.
Fantastic. Yeah. And to throw in one of Warren Buffett's quotes is their favorite, or it might have been Charlie Munger's, is their favorite holding period is forever.
Yeah, absolutely.
So,
Absolutely.
yeah. So as part of value investing, also looking for companies that actually have some inherent value. Like one of my favorite investments of Warren Buffett's is See's Candy.
Mhm.
Is, it's a business. It has physical location. It has a demand. There's a wide moat. Yeah, people could start another candy business, but I mean, is that part of value investing as well? Is looking for something that has that kind of tangible quality?
I would say yes and no. In the sense that in theory, not necessarily. I mean, or at least the way I'm interpreting your question, as long as you're buying something on a discount, that would kind of, from a broader sense, maybe categorized as value investing. But at the end of the day, and this is why the answer is also yes, when you put it into practice, it's almost hard to imagine finding something that's undervalued that doesn't have any tangibility to it. And I don't mean tangible as intangible assets, because you can have intangible assets, but I mean just the ability to produce cash flows over time. So if you look at something like, for example, Bitcoin or cryptocurrencies, it'd be really hard to think that you can practice value investing with Bitcoin because it doesn't produce any cash flows by itself. The price of Bitcoin depends entirely on what third parties and people are willing to pay for it. And so if you hold Bitcoin and nobody's willing to pay a higher price than what you purchased for, and the price continues to go down, you're not getting anything in return. So it's hard to do value investing in those cases. On the other hand, if you're investing in businesses like in stocks, then even if the price of the stock goes down, the underlying business still has a cash flow, and that cash flow comes from its brand, its operations, its products. So there's definitely something very tangible to it that kind of is aligned with value investing typically.
Definitely. And to get back to See's Candy, and that's a very small holding for Berkshire Hathaway, but it is a very predictable cash flow. Every Christmas, people buy a lot of See's Candy for everyone. And throughout the year, you can go to any See's Candy store and see the foot traffic. And I know, I don't want to take us down the Peter Lynch rabbit hole, but that was something that he talked about is, visiting malls with his daughter. And I can't remember if it was the Gap or one of those businesses. And he saw how crowded it was. And so he invested in it, that.
No, and you bring up a great point. And this applies, I think, to investing in general, but especially to value investing, since again, it typically tends to keep you in a concentrated portfolio, is you definitely have to do your homework. A lot of investors fall into the trap, and especially retail investors fall into the trap of kind of being headline researchers, where they're looking at the headlines and maybe they're something's very popular for the moment, or something's there's a lot of fear of a certain sector or whatever, and they're looking at the headlines and they base their decisions based on those kind of headlines, or maybe reading 1 or 2 articles here or there, conversations with friends. But it's very important to kind of really do very thorough research. And you mentioned Peter Lynch. He actually is famous for actually going and trying the products. I think there's a famous case where he even went to stay at, I think it was a hotel chain. I forget which one it was, but he went and stayed there just to see how good the service was, and things of that nature. And this doesn't necessarily mean the research always has to be on the road, but it definitely has to be very thorough, because one thing that's very important to understand in general, but again, particularly in value investing where you tend to be concentrated, is the importance of not putting your capital at risk. And this is in terms of a permanent loss, not about volatility. And Warren Buffett always used to say, the first rule of investing is never lose money, and the second rule of investing is never forget rule number one, right? And that's super
Yeah.
important. And it's a catchy phrase, and everybody or a lot of people know it and have heard about it, and it sounds great. But I don't think people fully appreciate the importance of it. And if I just may go off on a tangent for just a second, the reason why it's so important is because losses and gains, when they're permanent, they're not symmetrical. So if you have $100,000 investment and that falls 50% to $50,000, you can't make that loss back by just having a 50% return. That would only get you back to $75,000. So anytime you put your capital at risk and you actually lose capital permanently, then the climbing up of that loss is much more difficult than having lost it in the first place. And so it's very important to kind of have that in mind and be very, very cognizant about it.
Yeah, well, yeah, Jose, you bring up an important point, and I think though some people may hear it and feel like, oh boy, if I lose any money, then that's a bad thing. But we know that the stock market is, while over a 20 or 30-year period, it's going to go up. As you do have those sudden drops. Is how do people think about that in terms of never losing money? Because they can say, oh boy, on that day, like Black Friday or something, not what was it, Black Monday, where there was a huge loss, and some of these other days that we can point to. um how did
Yeah,
they deal with that?
absolutely. And what you're mentioning is actually the reason why value investing, even though maybe the simplest way of investing and maybe the easiest in theory, can be really hard, is because it does require a lot of kind of like patience and emotional intelligence, and most importantly, I think independent thinking. And what happens with the market is that, the volatility, the mark-to-market nature of it, prices either of a business individually of the market can drop 5% in a single day, in a bad day. And for individual businesses, it can often be 20 or 25% in a single day after earnings. And so that's why, as you're alluding to, it's very important to, on the one hand, have a long-term horizon, understand that the price is not necessarily a reflection of value. And that's super, super, super important, because that's how you can kind of keep your emotional intelligence. If you know what you own, the time horizon you're looking to own it, the competitive advantages of the business, you shouldn't necessarily be scared when the stock price drops 10 or 20%. And the same way goes the other way. You shouldn't necessarily be happy if the stock price goes up 10, 20, or 30%. Because again, price can deviate from value, especially in short periods of time. What you're interested in as a value investor is to kind of have the company compound its earnings over time, so that over time the market will be good at recognizing the value more or less, in a 5, 10, 15, 20-year period. But if you're focused on the kind of small periods, that's when you can lose your emotional intelligence, and you can start making mistakes of like, oh, but you can have FOMO and a stock going up, and you look at things like Palantir or many of these AI stocks that are very hyped right now, and you're like, oh, I don't want to miss the boat, so you start buying just because other people are hyped about it, right? And the inverse can be true as well. A stock can be going down, and maybe that stock is in China, for example, and there's a lot of noise around China, and you can get scared about all the noise that the media is kind of putting out there, and then you can sell, and maybe selling was a complete mistake, right? So it's very important to understand that the stock market is very, very volatile, but that shouldn't drive kind of like your decision making if you're a long-term investor.
Yeah, and just to add to that, I would urge people to go out and read Benjamin Graham, where he talks about Mr. Market and things like that to kind of get a better view of this. And as you point out, is if Apple loses 10% in its stock price in one day, that doesn't mean the value of Apple went down 10% in one day. They still are the same company with, the same products, same physical plants and cash flow and everything else. So that's something. So, one thing I want to make sure
Absolutely.
we
And if I may just interrupt there for a second, Tony,
sure.
sorry. Because that's one of the things that I actually try to do on my book is to try to show people how to value businesses in a way that's simple and that's very common sense and yet very, very true. Not like simplifying it just for the sake of teaching it, but simplifying for the sake of it's actually better to simplify things. And if you know how to value businesses properly, and it's an art and not a science, but if you can master kind of the art, then you can become very emotional intelligent. And of the 15 stocks that I have now in the portfolio for the fund, and I don't know this to be 100% the case, but I think all of them, but if not all of them, at least 10, I've had one day drops of more than 15% for all of them. And so if you don't know what the value is or what the value or what you expect the value to be, that can really scare you, right? And when things drop like that, it's because there's a lot of noise for whatever reason. And if you don't know your investment thesis well and your valuation well, then you're likely to sell, even though in many cases, especially if you did a good job earlier on with your research, selling would be a mistake, right? So again, I just want to put out there that the book does try to show you in a very simple way, in common sense way, to teach how to value businesses to avoid kind of falling on the emotional trap of the market.
Yeah, now that's the emotions are a big thing. So, before we wrap up, you've mentioned emotional intelligence a few times. It's a very important concept. Could you kind of go through a little bit what is emotional intelligence and how you cover it in your book?
Yeah, absolutely. So I covered on the book in various capacities. One, just in theory, kind of not necessarily what it is, but the importance of having it, and in doing and in shedding light around its importance, I kind of like explain what it is. But then also, as I go through explaining how to value businesses, I try to kind of teach people how to think independently in terms of valuation, in terms of a business potential future. And the idea for me about emotional intelligence is simply the opposite of, or it's grounded on being an independent thinker, right? Because if you're thinking about what other investors are doing, about what the market is signaling, about the headlines in the media, it's really hard to kind of go and feel fear at some times or feel FOMO at some times, and that's where the emotional intelligence aspect comes in, where you're letting your emotions drive your decisions versus your rationale, right? And the idea is to always try to be rational and always try to be independent thinker. And there's many things you need to do to be an independent thinker. One is no valuation, which we talked about, but also is things that are very basic, like just invest in things that you understand and that you know, right? Because if I, for example, go and invest in Nvidia, for example, it may be a great business. Its valuation, even though it's high, may be warranted and justified, but I don't understand that world sufficiently enough to be sure that if Nvidia has a 15% one day drop, I'll be calm about it and keep my emotions kind of intact. Maybe I do enter into fear, but that fear is going to be very well linked to the reality that I don't understand the business very well. So that's very, very important. Understand the business and the investment thesis that you had in the first place.
Yeah, and I think that's a wise observation for financial service and products overall. I come from an insurance consulting background, and that's something I found so often people would buy insurance policies that they didn't understand, and that never led to a good situation. So it's always a good idea to make sure you understand anything that you do, even beyond financial services. Any choice you make is you should understand it. And going back to Warren Buffett is, I'm trying to remember the exact analogy. I actually read it last night, is that he has three baskets on his desk, and one of the baskets is for companies that he doesn't understand, which is automatically something that Berkshire Hathaway doesn't even pursue when he goes, I don't understand the business.
Absolutely. You gotta be willing to let go of potential good opportunities, uh, even though you suspect they're good opportunities, if you don't understand them, because even if you end up being right, the chances that you're going to sell too early at some point or sell at a loss are very, very high.
Yeah, I completely agree. So, Jose, to wrap up, I have what's called the Get Ready Hot Take Trio, and these are three questions that I ask all of my guests. They're more rapid fire in nature. The first one is, what money myth are you trying to break?
Well, I'm trying to break the myth that everything is known in value investing from a theoretical standpoint. And I do try to kind of shed light on what I think uh, people tend to overlook, which is, and we didn't have a chance to talk about it, but the importance about capital allocation and what you do with the profits over time of a company is super, super important. Whether you repurchase stock, whether you do acquisitions, whether you return dividends to shareholders, and all that is super important. And that's kind of where I really dive into the book, and I try to tie it to how valuation works, because there you can't value a business, and that's my argument essentially. You can't value a business if you don't think about the capital allocation decisions that are going to be made over time for that business. And so that's kind of like the myth that it's, or the kind of unspoken myth that capital allocation is secondary, is what I'm trying to kind of put out there.
That's important, and I think that's a good reason for people to pick up your book and check it out, is because it's the kind of stuff that we don't always talk about. As you mentioned earlier, like Bitcoin, but these understanding these principles, it will help people become better investors. And if you're an advisor working with clients, these are the types of conversations you have to have with your clients. So, Jose, let's get out the time machine for a minute. If you could go back in time, what advice would you give your younger self, knowing what you know now about money and investing?
Sure. I think, and I gave this question kind of a lot of thought, or I've given it a lot of thought, and I think I would have loved to start investing much earlier than I did in public markets. And the reason is not because it's necessarily for everybody, or because everybody can do it well, but because you can do it with small amounts of money and learn a lot. I mean, you're going to learn a lot more from investing just $500 in the stock market and pick three or four businesses. You're going to learn more about investor psychology, business performance, management, capital allocation decisions, and so many other subjects just by doing that very early on. That and the fact that you can do it with small amounts of capital is great. So I would have loved to start kind of earlier on, and I encourage people to do so as well. And that applies even if you're more like, getting closer to retirement, because again, you don't have to necessarily invest, 20, 30, $40,000. You can just do it with small capital, but it'll be enough to get you incentivized to keep learning. And even if you don't end up, investing in public markets a significant amount of money later on.
Yeah, no, that's great advice. And it's one of the, probably the most popular piece of advice, oftentimes also coupled with compound interest, is, the other benefit of starting to invest early. So to
Absolutely.
wrap up, what is your number one tip for changing how we think about money?
Well, I think my number one tip would be don't ignore management team's capital allocation decisions. That I think is my number one, not only because I do think it's among the most important things, but also because it's very misunderstood and seldom taken into account. So that would be my number one tip.
Oh, fantastic. So, Jose, where can people learn more about you and, most importantly, pick up a copy of Wall Street's Blind Spots?
Perfect. Thanks for asking. You can pick up the copy of the book on Amazon, and you have both the Kindle version or the physical version. And if you want to know a little bit more about myself, I also have a website called josemayora.com, or you can contact me via LinkedIn. So those would be the three primary ways you can kind of learn more about myself.
Fantastic. And for everybody watching and listening, as always, there will be links to Jose's website, the book, and his LinkedIn profile in the show notes. So if you have access to the show notes, you can find the links there. So Jose, thanks for coming on the show today.
Thank you for having me, Tony. It was a pleasure.
Yeah, and thank you everyone as always for tuning into this episode of the Get Ready Money podcast. If you learned something today to change the way you think about investing and financial literacy, please be sure to subscribe and to share with a friend. You can also go to my website at tonystewart.com to join the Get Ready movement and get access to a whole bunch of free resources. Until next time, let's change the way we think about